Thank you for joining us today. It's a privilege to be here with two leaders of financial services industry, C.S. Venkatakrishnan, CEO of Barclays, and Jeffrey Gundlach, founder, CEO, and CIO of DoubleLine. The idea here is really to discuss the collaboration and partnership between DoubleLine and Barclays, but perhaps use that as a jumping board into markets and how clients are thinking about engaging with Barclays and DoubleLine. So perhaps, Jeffrey, I could ask you how the collaboration with Barclays came about and also how it's informed the strategy of DoubleLine as you've been growing in business.
Yeah, thanks. We started out a relationship back, I'm going to say it was 2011 or 2012. And I think it was something to do with our total return strategy, getting like clients some sort of note or some warrants, some synthetic exposure to it. And that's how we sort of got to know each other. And there was this index that used the Dr. Shiller from Yale, his cyclically adjusted CAPE ratio. And there was this idea that maybe we could offer a mutual fund with that as the underlying decision rule. But it's been a really good working relationship. And the team at Barclays working with Sherman early on to do the CAPE strategies, the European and the US, was really helpful, very open, and it's really been a pleasure.
Thank you, Jeffrey. Venkat, what about yourselves? When you think about partnerships, collaboration, what are the factors that you consider when you're trying to work with a firm like DoubleLine? Well, there's French philosopher Victor Hugo said, there's nothing more powerful than an idea whose time has come, which has two parts. The idea has to be good and its time has to come. And I would say when you think about a partner, on top of that, the idea has to be good, the time has to be right, and you've got to have a great partner. Now, I spent the first 15 years of my life in finance as a fixed income portfolio manager and was from a very far distant spot on the East Coast, admiring what Jeff had done, not just at DoubleLine, but before DoubleLine as a fixed income manager. And so while we are not in the asset management business, we spend a lot of time thinking about what good investment strategies are for those who provide them, which we don't, but we like to work with you to provide them. The second thing is, I think, over time, you see inefficiencies in public benchmarks as they're constructed. So what we try to do is to create that kind of benchmark, which we did with the Case-Shiller Index, which has a good general property of risk-return Sharpe ratios to it. And then there's a delivery vehicle that's important because you've got to cover the costs and you've got to generate enough alpha so that you get that index and you get a little bit more and cover fees and costs, which is what your fixed income capabilities working with us do. And then ultimately to sort of, the idea has to be there and packaged well with a good partner and the time has to come.
Yeah.
Thank you. Jeffrey, maybe stepping back a little bit, just in terms of clients, as they think about the next 12 to 18 months, some of the broad themes I think you've already touched on more publicly, people are familiar with, but maybe for the Barclays network, what are the sort of opportunities you see ahead in the next 12 to 18 months?
Well, I think that you have the beginning of what's going to be a long-term trend of the U.S. no longer outperforming the rest of the world in stocks. And in fact, if you're a dollar-based investor, I'm so bold as to recommend that people think about buying foreign stocks and not, and taking the currency risk. Because I've been talking about this publicly for a while, that I think the dollar is no longer acting as a safe haven. I don't think that's an opinion any longer. I think you just have to analyze the data. When the S&P 500 fell, it corrected back around April 2nd with the tariffs. The dollar typically in a S&P correction going back a couple of decades, there's been 13 market corrections in the S&P 500. The first 12 of those 13, the dollar rallied every time. It went about 8 to 10%. But during the tariff tantrum earlier here in 2025, the dollar dropped. And I think that is very, very telling that it's no longer being treated as a safe haven asset the way it used to be. And you see that in the dollar value of gold as well, which is very momentum. You've got momentum in gold for sure. I do a slot on CNBC after the Fed press conference. I've been doing it. I think I've been at 37 or 38 times, which is amazing. It's been that many, because it feels like yesterday I did the first one. And I was predicting, I had predicted that gold was going to go to 3,000 in 2025. And when I was on the show, I was asked the question, do you still think it's going to go above 3,000? And I said, what kind of a question is that? It's a 2970. You're asking me, can it go up another percent? And so I said, I think gold is going to go to 4,000 this year. And so here this week, yes, the gold price made an honest man of me. But I think we have moved, and we're seeing demand. Our emerging market team is starting to see demand for EM that was non-existent as the dollar was going up. And we're seeing crossover buying. We're seeing interest in emerging markets. And I recommend emerging markets as part of a portfolio. We, for the first time in the 16 years that DoubleLine's been around, here 2025 was the first time we bought local currency emerging market debt. And we think that's in the early innings of that. And we're seeing a lot of inquiry coming in about those ideas. So a lot of people thinking about protecting themselves from a falling dollar, or, adding some real safe haven assets, which some people will buy cryptocurrencies for that. They're the risk takers. Others will go with the tried and true gold, or some of the small money players, they like silver, because when it really gets going, silver is the high beta asset. And that has happened this year. And so those are things we're really looking at. We're also very leery of long-term treasury yields. We think that just like the dollar could go down during a recession rather than going up whenever a recession would come, we think that we think that there's a lot of momentum in some of these true hard asset plays. So that's what we've been doing, and recommending very unusual asset allocations for relative to where we would have been. Because I think that the paradigm that defined the first 40 years of my career has ended, and that is there's not going to be secularly falling, at least long-term interest rates. And there's a lot of inquiry about that, and demand for things that might be 7 years and in, which is what we recommend in taxable fixed income. As unattractive on a historical spread basis as most fixed income sectors are, we're only leery of things that are very down in the capital structure, triple C, things like that, which are starting to default, particularly in the bank loan market. So we're interested in things that have a spread over treasuries, and that means asset-backed securities, some mortgage-backed securities, commercial mortgage-related securities, mostly securitized assets, credit cards, asset-backed, where you don't have to do a lot of gymnastics to avoid the long end, because there isn't anything at the long end. And so for the time being, we have very little interest in long-term treasuries. And yet we are mindful of the fact that the administration may do some interesting things in case the interest expense becomes a really big problem. It's gone from $300 billion 5 years ago per year to $1.4 trillion. And there's a couple trillion of bonds keep getting issued every year. So these are the themes that we're talking about. Clients tell us that this idea of avoiding lower credit, and also of avoiding the long bond and thinking that the Fed will ease and will steepen out the curve. Some of our biggest clients that use many money managers, they say it's like everybody is saying this. And so doesn't that make you worried? And yes, it's an invitation to be worried, but sometimes the consensus is right. And I think that people are on to that. One last thing, we're talking a lot and noticing a lot of flows. For about 18 years, money flowed into the U.S. market from foreigners. It went from $3 trillion on a net basis back 18 years ago to, by one measure, $28 trillion earlier, maybe 3/4 ago. That's $25 trillion that came into the U.S. market over about an 18-year period. So you're talking about $1.5 trillion a year. No wonder the U.S. outperformed. but the dollar isn't going up anymore, so that doesn't make it a good thing for a foreign investor who it comes into the U.S. So and the money has started to leave the last couple of quarters. So all of this leads us to think carefully, and we're getting a lot of discussions and inquiry on this, as I said, about diversifying more than you used to into non-dollar investing, particularly for dollar investors.
Thank you, Jeffrey. I mean, Venkat, you have the privilege with Barclays of the breadth and depth of the Barclays network. What are you hearing from clients and investors, and maybe specifically within your wealth channel and your institutional channel? I mean,
I'll focus a little less on where relative value sits now, but more what we think about and concern ourselves with longer term trends. It's absolutely true what Jeffrey said, which is that we have had over the last 35, 40 years, quote unquote, secularly declining level of interest rates, which has now begun renormalizing. It's still even now below sort of normal-ish levels. And what people in the bond market call the term premium has slowly reasserted itself. Now, there are two other things, though. One is you've had, as Jeffrey's pointed out, an appreciating dollar in this period because of an asset flow that's come into the U.S. It's coming for two reasons. One is U.S. markets themselves have been attractive. And second is, as global trade bloomed, and there was enormous globalization, there was a movement of dollars into the hands of exporters and away from the United States. Those dollars had to be reinvested somewhere. They came back into U.S. assets, including government bonds, treasuries, and all the way up to equities. With what's happening with tariffs, you've got to assume that some of that flow is going to correct, so that on the margin, those flows are going to decrease. The second thing, as Jeffrey's just referred to, we have been in probably an 18-year bull market for spread assets. Right? I mean, there was a hiccup during COVID.
But they didn't last any length of time.
Yeah.
The hiccups.
No, the hiccups did not. So what keeps that going?
Yeah.
What keeps that going is the strength of individual consumers and actually of corporates. I don't know what's going to cause that change, but it is something that you've got to, if you've got a medium-term asset allocation, be prepared for. So to answer your question, I think there's obviously a role for a broad diversified set of both currencies and government bonds and assets. Second is the shifts are going to be less favorable to dollar assets and more favorable to non-dollar assets. Now, having said that, there is also a huge amount of investment that's taking place. Data centers and AI is one notable example. But the tech economy is requiring both investment and potentially can create disruption in the employment market based on what productivity gains people are able to realize, or if they don't realize them, companies feel they have to show them. Right. So from our side, it is to get the broadest exposure, to try to do it in such a way that in the medium term gives you some protection against defaults and the turn in the credit cycle. I think parts of the world economy and emerging markets are growing very well, and they represent an attractiveness. And I think, though, from our wealth and our private banking channels, people are looking for the breadth of that exposure.
Yeah. Thank you for that. And related and following on, given the sort of ongoing shifts in the market, you've obviously had a strategic plan you're implementing for Barclays, very well received so far by the market. So congratulations on that.
Thank you.
I really wanted to ask you about leadership questions and what you've learned as you navigate the bank, but also the markets and what's going on in terms of the world.
It's, we live in a complicated world, and our tendency is to make it more complicated than it is. So I think it's really important, whether it's an individual or a company or a business, to identify what you're good at, identify what your customers uniquely need from you, how best to deliver it in a cheap way and a cost-effective way, but also in high-quality service. And to manage your businesses, your business footprint, and your business targets with that aim in mind. That's what we are trying to do. There's a lot more to go, but I think for an investor in Barclays. They've got to know what this bank stands for, what it's capable of doing, and that our customers like our products. And then as a result of that, show the financial metrics they'd look for in any bank, right? Interest income, earnings, good risk management, management of credit losses.
Thank you. Actually, on that point, Jeffrey, for yourself, for DoubleLine, where do you see the opportunities for growth, and how are you positioning the firm?
The most important thing from my seat is to keep the turnover of the investment team as low as possible. And we've certainly accomplished that. How do you do that? Well, you make people partners, for starters, and you have a culture that is a good one to work at. There's a lot of competitive, kind of aggressive people in the financial business. A lot of times money managers have very big egos, and it's having a culture where nobody is sad when somebody else succeeds, that everybody rows their oar in the boat in the same direction. So I believe that if people are to have responsibility, they have to have accountability. And if they're going to be accountable, they need responsibility as well. And those things go together. And I'm not yelling at people ever. We're all working together. I remember when really good example was when the lockdown came, and it was just absolutely dead center bullseye on commercial real estate. And the commercial real estate securities market had no bid. And my CRE team, the team Morris Chen, after a strategy meeting where it was really grim. I mean, I remember that 1 week where we had some redemptions going on and in the emerging market sector, and there was no bid. The bid was zero. I mean, the bid was pass, basically. And Morris was really feeling bad about it because commercial real estate is the hardest hit. And he called me up and I said, "This isn't your fault. I've been through this stuff a lot of times. We're going to get through it. It's not as bad as you think. And all you can do is stop worrying about it and work on it. Not worry about it, work on it." And it's turned out to be one of the best investing areas. Of course, it was very hard to get clients to even pick up the phone when he talked about commercial real estate. You could say, "Well, we're not talking about office. There's a lot of things. There's data centers.
Yes.
There's other things." But we ended up getting traction with that. The model in investment management is often silos that actually compete with each other. And so there's a parent company. It's often owned by a bank or insurance company, often non-US. And sometimes they have equities, and they might have 5 value teams and 5 growth teams, and they're all competing with each other. And the business philosophy is one of these is going to have a hot dot. Somebody's going to be in the upper decile because of the randomness of it. And the marketing of those entities is typically push the hot dot. So when team A has a median dot and team B has a top decile dot, the marketing force is unleashed on the hot dot, and the people who are the median dot, whenever the hot dot people get an account, they have it look like a death in the family, right? And so I reject any kind of marketing on hot dot. I think it's like a really dumb idea. It's the epitome of buy high.
Yeah.
And then if you're a hot dot buyer, you're going to be a low dot seller, and you just end up spinning your wheels. And so we're much more interested in, having pure plays on sectors and maybe being able to glue them together for a combined core plus or diversified portfolio. And a lot of places you sort of eat what you kill. Your compensation depends on your team's AUM. We have none of that at DoubleLine. If bank loans gets a $300 million account, everybody's happy. Everybody. And that's a culture that a lot of our clients really appreciate, because, I mean, somebody said to us, you guys are much friendlier and, in a certain sense, a little bit more laid back than a lot of, your your high-powered, jam the hot dot products competitors.
Thank you, Jeffrey. Just looking forward now, perhaps in a slightly more optimistic sense, what are you optimistic about for 2026? Maybe perhaps Venkat, I could start with you.
Well, what I'm optimistic about is that the global economy in 2025 has survived shocks that we would have thought might have dented it. If you go back to January, people gather at Davos in Switzerland, everybody was using the term American exceptionalism. Right.
That's a synonym for U.S. markets outperformed other markets.
Exactly.
That's all it is.
Exactly. Then by April, people have their doubts. And now it's come back up.
All the way back.
All the way back up. But I think you've got to look more fundamentally. You've got to look at the fundamental issues of inflation, employment, and corporate profits, wage growth. I'm reasonably confident that the momentum will continue. But there have been shocks to the system that require a lot of rewiring in the corporate world. So I don't think the risk is beyond, we're past the risk point of risk. So we've got to be watchful, and I would say cautiously optimistic.
Thank you. Jeffrey, what are you optimistic for 2026?
I'm more optimistic than a lot of people on not the lower tiers of corporate credit. The spreads on investment-grade corporate bonds are basically at the tightest of all time, other than back in the early 80s when I started in this business, when we had a shocking development that's IBM bonds traded through treasuries. Well, that's happening now again.
Yeah.
Microsoft is trading through treasuries. And I think that's not random. I think that's because people realize that the corporate public market doesn't face maturity wall. The CFOs did a much better job than the U.S. government in managing their debt burden. When rates were low, we were running 84% T-bill issuance. You should be locking in low rates for longer. But what's happened is that while spreads are tight, very tight on investment-grade corporates, the quality is higher than it used to be. And the same can be said for the high-yield bond market, where, yes, the spreads are very low by historical ranges. They were only lower back in 2007 and not by very much, but the market was so much worse in 2007. So what's happened is with the deluge of private credit being raised, it's my belief and my observation that a lot of the junky stuff that used to find its way into single B- and triple C junk bonds is now going to private credit. And so where the real risks lie on the default cycle, in my view, are more in these lockup situations, private equity and private credit, because their heyday was over about 2 years ago, even though the money keeps piling in on funny arguments like, Sharpe ratio arguments that rely on the fact that you don't mark to market on the private side. 5-year past performance, which was 2 years ago, private credit looked great on a relative basis, because when you marked down your corporate bonds in the public market, there was a bear market, and you had to show those marks. And what typically happens with private vehicles is they're kind of a lag. The prices are almost a moving average rather than a spot price. So I'm pretty optimistic about that. I'm optimistic about, like I said, local currency emerging market for the first time. I like non-U.S. investing broadly, and I'm always optimistic for the long term. I'd say this has been for the last 10 years. I've always been optimistic on India, not as a 30-day, 30-week, you're not even 30 months. I'm talking about 30 years because of the demographic shifts that forced, I guess I would say, China to change its economy and bring people in and employ them, with hundreds of millions of people entering the workforce. That's going on. That's now in reverse gear in China, and that's coming now for the next quarter century, I think. And demographics are, the future that's already been determined.
Yes.
And I'm a big believer in demographic-based investing. That's one of the challenges in the United States is we now have negative net immigration, which obviously is going to change a little bit of the way we think about the employment data. So with negative immigration, and we have the births versus deaths situation is turning negative in terms of shrinking population based on very low fertility rates and very rapidly aging baby boomers. I'm pretty optimistic on the 5-year type of U.S. bond market. And I'm optimistic on currency translation. I know I'm repeating myself, but it's by far my highest conviction is that you're going to make money on currency translation because it's already happened. And on the recession thing, it's interesting how once we went from secularly declining interest rates into what appears to be secularly rising, the old inflation indicators aren't working very well. The leading economic indicators have been signaling recession for years. And they're still just totally bombed out. And you've got the yield curve stuff where when the yield curve, when 2s, 10s inverts and then steepens, that's almost always the front door of a recession. That hasn't worked. The unemployment rate versus the yield curve hasn't really worked. But again, what we've got is this strange pattern of a reduction in demand for workers being matched with a reduction supply of workers. And so we have Jay Powell discussing this openly at his last press conference. So with the range of jobs was 100 to 150,000 per month, and now it might be 0 to 50,000, and it might just be zero. I mean, the ADP just came out negative, and although that's a flaky number, it's all over the place. Come out zero, but I'm a little bit concerned that we might run an inflationary policy somewhat intentionally because Trump wants short rates down, but maybe it's not entirely intentionally. If you use the data interpretations of the past, zero would encourage easing. And you know that if zero jobs, say we have a 3-month stretch where the average is zero, there's going to be a lot of jawboning on we got to get this interest rate down pronto. And it might not really have to do with the firing balances. It might just have to do with these demographic changes. And so we're watching out for that. And, we have a test case on what might be happening when Jay Powell leaves, because we got that guy Myron who got on there and right out of the gun, he dissented. He wanted a 50 basis point cut last September, and he wanted 5 more by year end. So the guy's out there at 175 basis point cuts by end of the year, and Powell's out in May, and he's going to be as stubborn as he possibly can be because he doesn't want to be one of these guys that gets inflation pinned on him. But Trump is going to ask people who are the candidates presented by Scott Bessent, he's going to say, will you put the rate where I ask you to? Maybe not that directly, but that's certainly been kind of his complaint. And if that were to happen, the inflationary policy would be increasingly more likely. This is another reason why I'm not really interested in long-term treasury bonds.
Thank you, Jeffrey. Perhaps to end on a slightly more non-correlated topic of sport. Venkat, I understand you're a passionate cricket fan, which I don't know in the United States whether that translates.
You wake up early in the morning. Yeah.
Just curious how 25 has been for you in terms of...
It's been good, actually. I managed to see a few matches in London, few entertaining matches, but it's been a good season.
It's been a good season. Did you watch the England?
I watched 2 days of England, India. Yeah.
How was that for you?
It was good. It was
down to the wire.
Get out to the wire.
I can't watch cricket because I don't understand the rules.
Jeffrey, for you and your beloved Bills, what's your view for them in the coming season?
Very optimistic. But in football, it's really always comes down to injuries. If you have significant injuries, your season kind of evaporates. And we've had a few injuries. Obviously, the one that matters is the quarterback. And he has started every single game in his career. And he's really never been injured. Yeah. But seriously. But as long as you got Josh Allen, you have a chance to go all the way. And so we're going to remain in bull mode on the Bills' chances this year. I'm almost certain they'll be the number one injury in the AFC. We would need a serious injury to stop that, I think.
Good. Well, we hope so. Thank you very much. Thank you for your generosity in hosting us here. And Jeffrey, thank you for your time. Pleasure. Thank you.
I enjoyed it.
Yeah, thank you. Thank you.